If you're an investor in DBS, you've probably seen the headlines from their latest 3Q 2025 results. On one hand, you see a record-breaking quarter and a massive 75-cent dividend declared. Your brokerage app shows the stock trading near all-time highs. But then, you dig into the guidance for 2026, and you see management signaling profit pressure. They're guiding for net profit to be slightly below 2025 levels, maybe a 3 to 5% drop. This is a confusing moment. With net interest margins shrinking and Fed cuts ahead, should you be taking profit, holding on for the dividend, or exiting your position entirely? But here's what the headlines are missing. This isn't a story about a bank falling off a cliff. This is a story of transition. Yes, the tailwind from high interest rates is over and net interest income is falling. But if you strip away that noise, you see a new engine taking over. DBS's wealth management and fee income businesses are surging, hitting new records. This is a far more complex story than just profits are down. The real question is whether this new engine can grow fast enough to offset the margin compression. And more importantly, is the current 5.5% dividend yield your reward for waiting, or is it a trap? I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise and show you what really matters for your CPF, SRS, and SGX portfolios, and we've been putting in the work. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, slide by slide, through DBS Bank's 3Q 2025 results and their crucial 2026 outlook. We'll start with the CEO's strategic view, then dive into the CFO's hard numbers. First, let's look at the CEO's presentation, starting with his summary of the record quarter. He highlighted 3 key pillars. The first is net interest income resilience. Now, what this means is that management hedged their bets. They proactively locked in higher rates on about 1/3 of their commercial book. They also took all the surplus deposits flooding into the bank and deployed them into what's called high-quality liquid assets, or HQLA. Think of this as a smart insurance policy they took out before rates dropped. The second pillar was capturing structural opportunities. This is all about wealth management, where DBS saw both fees and assets under management hit new highs. The third pillar was digital asset capability. DBS is pushing hard into tokenization and blockchain, issuing tokenized notes and seeing over $1 billion in crypto options traded by clients. For us as investors, that first point on NII resilience is critical. It means management wasn't caught sleeping. They knew rates would fall, so they proactively locked in higher yields. This is the cushion that softens the blow. The digital asset part is interesting. It's a long-term bet, not a 2026 profit driver, but it shows they are thinking about building future moats. Next, the CEO talked about macro observations. He highlighted 3 trends: the shift in trade flows due to tariffs and supply chain changes, a revival in capital markets, and the internationalization of the Chinese renminbi. DBS is framing itself as a differentiator bank that uses its digital platform and regional presence to benefit from these shifts. What this slide is really telling us is that DBS is positioning itself as the Switzerland of Asia. In a world with geopolitical tension, they are betting that capital and wealth will flow to a trusted, neutral, and digitally savvy hub. This isn't just fluff, this is their competitive moat. They want to be the primary bank for high net worth individuals and corporations navigating these global shifts, and this directly fuels their wealth management engine. Now we come to the most important slide of the entire presentation. This is the 2026 outlook, and it's the one causing all the anxiety. Let's break it down. First, management guides for total income to be around 2025 levels. That means flat. Second, group net interest income, or NII, is guided to be slightly below 2025 levels. This is the main headwind. Third, commercial book non-interest income, think fees, is expected to have high single-digit growth, with wealth management leading the pack at mid-teens growth. This is the tailwind. Fourth, the cost-income ratio is expected to tick up into the low 40% range from 39% today. This means they are spending a bit more. And finally, the bottom line, net profit is guided to be slightly below 2025 levels. Given 2025 is tracking for $11.5 to $11.6 billion, this implies a 2026 profit of $11.0 to $11.3 billion, roughly a 3 to 5% decline. Let's be very clear about what this means. 2026 is a transition year. The party from rising rates is over. The bank is telling us point blank that profits will take a small step back. The bull case rests entirely on that high single-digit fee income growth. Can wealth management grow fast enough to pull the entire bank forward? That's the bet. For us, this signals that capital appreciation on the stock will likely be limited in the next 12 months. The story for DBS shifts from growth to defense and yield. Now let's move to the CFO presentation to see the hard numbers behind this story. The CFO's highlights show a record 3Q pre-tax profit of $3.48 billion and a strong return on equity of 17.1%. The balance sheet is described as strong, with the NPL ratio stable at 1.0%. And of course, the 75-cent dividend. But let's look deeper. Slide 2 shows the 3Q net profit declined 2% year over year. When we look at the earnings bridge, we see the story clearly. Commercial book net interest income fell, creating a $238 million drag. But this was almost entirely offset by a $248 million gain from fee income and another $108 million from markets trading. Expenses rose, and after some tax and provision adjustments, we land at a 2% decline. The next slide, however, shows 3Q net profit up 5% quarter over quarter. It's the same story. NII was a negative $67 million drag, but fee income, led by a surge in wealth management, added a massive $190 million positive impact. When we look at these profit bridges, we see the same pattern again and again. The old engine net interest income is the red bar, the negative number. It's a drag. But the new engine, fee income, is the green bar, the positive, that is almost completely offsetting it. This confirms the transition thesis. Now let's talk about the core problem, net interest margin, or NIM. This is the bank's core profit margin, the difference between what it earns on loans and what it pays on deposits. The CFO slide shows the commercial book NIM compressed hard. It fell 43 basis points from 2.83% down to 2.40%. This is the headwind made visible. That 43 basis point drop is precisely why 2026 NII will be lower. The bank's hedging and deposit growth buffered the total NII, but the underlying margin pressure is undeniable. With SORA rates now down around 1.2 to 1.4%, this compression will continue. So if NII is under pressure, let's look at the balance sheet. This is where we see the bank's defensive strength. Deposits grew a very strong 9% over the first 9 months, led by CASA, which are the low-cost current and savings accounts. This is a flight to quality. People and companies are parking their money at DBS for safety. But here's the interesting part. Loan growth was flat. So what did DBS do with all this new cash? They deployed $30 billion of it into high-quality liquid assets, HQLA. This is exactly what you want to see as a conservative long-term investor. DBS is attracting a flood of deposits, but instead of chasing bad loans just to show growth, they are being disciplined. They are parking that cash in safe, liquid assets. This prudence is what protects the bank and our dividends during uncertain times. Now for the good news. Let's look at the new growth engine. Fee income. It's at a record high. The star performer is wealth management. Fees from this segment surged 31% year over year. Assets under management, or AUM, are up 18% to a massive $474 billion. This is the core of the bull thesis. This isn't just a cyclical bounce, it's a structural shift. DBS is successfully transforming into a wealth powerhouse for Asia. This segment now provides nearly 1/3 of the bank's total income. This is high-quality recurring revenue that is not dependent on interest rates. This is the engine that needs to carry the bank through 2026, and management is betting it can. Finally, let's run through the defensive metrics. First, costs. The cost-to-income ratio is stable at a best-in-class 39% for the 9 months. The guidance for a rise into the low 40s is something to watch, but management says this is for investment in wealth and digital, not runaway spending. Second, asset quality. Let's talk about non-performing loans, or NPLs. The NPL ratio is stable at a very low 1.0%. In fact, the CFO pointed out that new NPL formation was at a multi-year low in the third quarter. Specific provisions or money set aside for bad loans are at a low 13 to 15 basis points. And their total allowance coverage is a massive 139%. Asset quality is pristine. There are no signs of stress. Third, capital. The bank's CET1 ratio, which is its core safety buffer, stands at 15.1%. This is far, far above the regulatory minimum. This is a fortress balance sheet. And this brings us to the dividend. DBS declared a 75-cent total dividend, which is 60 cents ordinary and a 15-cent capital return. This represents a 72% payout ratio. Let's put this all together. The asset quality is pristine. The capital ratios are a fortress. This is why management can confidently pay out 72% of its earnings as a dividend, including a special capital return. They are signaling to us that the balance sheet is so strong they can weather the 2026 profit dip and still reward shareholders. The dividend is not at risk. It is exceptionally well covered by both earnings and capital. All right, we've gone through the slides. Let's cut through the noise and summarize what this means for our portfolios. First, what's working? The balance sheet is a fortress. Asset quality is pristine, and capital is well in excess of requirements. This means the dividend is rock solid. Second, the new growth engine, wealth management, is firing on all cylinders, with AUM up 18% and fees surging. This is the structural tailwind. Third, the deposit franchise is a key competitive advantage, attracting a flight to quality. Now, what's not working? The primary headwind is net interest margin compression. The tailwind from high rates is gone, and this will drag on NII and overall profit in 2026. Management has told us this directly. Second, loan growth is flat, which means they can't offset margin compression with volume. Third, the stock is not cheap. It's trading near all-time highs, pricing in a lot of the good news. In terms of valuation, at a price of around $55, the stock is trading at a price-to-earnings ratio of about 14 times its forward 2026 earnings, which are expected to be flat to slightly down. Analyst fair value estimates are clustered around $51 to $53. This suggests the stock is currently fairly valued to slightly overvalued. So here's my final recommendation. This is split into two parts. First, for existing unit holders, my verdict is to hold. You are being paid a very attractive 5.5% dividend yield to wait out this 2026 transition year. The dividend is safe, and the long-term wealth management story is intact. There is no reason to sell a high-quality bank just because of one flat year. Second, for new buyers, my recommendation is to wait. The risk-reward just isn't compelling at $55. Why buy at an all-time high when management is guiding for lower profits? The margin of safety isn't there. I would be a more aggressive buyer on a pullback. I'd wait for an entry price closer to $50 to $52, which would lock in a much more attractive dividend yield of 5.8 to 6.0%. If you found this deep dive analysis valuable and want to get this level of insight before the market reacts, consider becoming a free or paid subscriber to my Substack newsletter. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 15 paid Substack members who make this in-depth independent research possible. Thanks for watching, and I'll see you in the next analysis.